Axis Bank is the top Nifty loser, trades with cuts of over 4% as slippages rise sharply in the first quarter. Management attributes this deterioration to technical factors and expects slippages to remain muted going ahead.
Wipro is the top Nifty gainer, up nearly 3% after the first quarter numbers meet estimates. The management also tells CNBC-TV18 that they're seeing strong deal momentum and that they expect the second half of the year to be even stronger.
Shares of Tata Communications gains after reporting first quarter earnings. The margins expand sequentially. The management tells CNBC-TV18 order book position is stronger than last year.
Nuvoco Vistas trades high after the profitability recovers in the first quarter, driven by focus on cost as well as sequential jump up in realization by around 5%. They also go ahead and reduce their debt. Overall, the stock is trading high with a gain of 3%.
Shares of Clean Science fall over 6%, 7% now as the management expresses caution on meeting its EBITDA growth guidance of 18 to 20%.
Hello and welcome to Chartbusters. We are coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And as you can see at the top of our screens, well, the markets are under pressure. The Nifty is now down closer to under 170 points. We're at a very, very crucial juncture because now the Nifty has gone below that 50 DMA. We've broken that 25,000 odd mark. Remember, that's a 50% retracement of the recent bounce that we saw. It's the recent low. It's where the 50 DMA is at as well. So this range of around 24,950 to 25,000. By the time we wind up, you'll want the market to get past those levels. The problem today is the Nifty Bank. That's down more than 500 points. Axis Bank's numbers were weakish. But to be fair, that one is holding above the day's low. So the first hour lows, it's defended out there. But the other larger banks, in fact, have come in for some profit taking. So the markets need to reverse. It has to be reversed from this sort of a zone because that's where the important support lies in it.
Absolutely. A lot of put writers at 25,000 as well, Nigel. The important part, however, for the Nifty Bank is that yesterday, after a very long time, it broke below its 20-day moving average. So let's see whether that weakness sustains or not. And even despite the up move that we're seeing on Wipro, the IT index, the other IT heavyweights are not supporting the cause of that index. So both the heavyweights, both the Nifty Bank as well as the IT index, currently at the low point of trade. So we have the IT index lower despite the Wipro stock being higher by about 2.5%. Broader markets not doing well. In fact, straight off the bat, we have 1,800 stocks which are declining for about 700 stocks which are advancing. So the red and green lines far wide apart and makes your portfolio look a little weak on this Friday morning. Take a short break. In fact, as we do that, we'll get you some ideas for profit coming in from our colleagues at Money Control Pro. Jitendra Gupta joins in with a stock that he's tracking.
We think Bharat Electronics is one of the few structural growth stories riding on the defense spending, supported by its market share and capabilities. Moreover, fundamentals are improving now on the back of strong order inflows and execution. In Q4, if you look at BEL posted a healthy 6.8% jump in revenue. EBITDA surged by almost 23% on a year-on-year basis, and margins expanded by around 400 basis points, led by higher, led by favorable revenue mix. The company's order book now stands at around 72,000 crore, which is nearly 3 times its annual revenue. With fresh orders from the naval indigenization, S-400 system and BrahMos subsystem, BEL is building strong revenue visibility for the next 2-3 years. The management has guided 15 to 17% revenue growth this year, and it is targeting 20% annual growth after for the next 4 to 5 years. The company is doubling its R&D expenditure, expanding its capacities, and exploring global defense market, including Europe, where we have seen some uptake in defense budget. On the valuation front, stock is trading at 45 times its fiscal FY27 estimated earnings, which is good considering strong earnings visibility and increasing opportunities in the defense.
Welcome back. You're watching us here on Chartbusters on CNBC-TV18. See it. That's the stock on our radar. The company reported its numbers where revenues were below expectations, margins were under pressure, and we had the raw material costs which spiked as well. The company announced a 450 crore rupee capacity expansion plan for its Chennai plant. Arnab Banerjee, who's the managing director and CEO of the company, now joins in. The stock lower by about 1.5%. Arnab, remember having this conversation with you just about a fortnight ago, where you said that there are some challenges when it comes to raw material, and you see expectations coming by only, expectations of an increase coming by only post the second quarter. Was this magnitude of impact expected? Because no one on the street was working with this number. And how much worse can things get before they get better? And by when do you expect them to get better?
Yeah, good morning. Pleasure to be here. We expected about 0 to 1% kind of benefit in raw material, which has not come through. It is flat, more or less, because of the inventories that we carry. Our growth has been pretty robust. If you have seen 11.5%, so that we will continue to grow in double digit right through this year and maybe accelerate from here. So that part is sorted. Domestic growth has happened very, very well, both OEM and replacement. International business is where we had a flat growth. There were headwinds in almost all the markets because of geopolitical uncertainties, tariff uncertainties. The trade was not stocking up because of these uncertainties. And now looking at the future, the international business where we had headwinds is going to be slightly better in Q2 because we have view of the order book that we have, the seasonal order book of Q2, especially from Europe has all come in. So we expect Q2 to be better in international. Domestic growth in OEM as well as replacement is going to be robust. As far as margins are concerned, Q2 definitely there will be a flow through because the inventory consumption has happened with 11.5% growth in Q1. So we expect much more benign and lower raw material cost in Q2, and we expect to hold our pricing. So the margin outlook is better.
So what is the outlook?
Well, it all depends on many things, right? Exactly how much the raw material cost will come down by. We have maintained that we don't want wild swings in margin. So our margin in the last 2 quarters have been 11.5 and 11 roughly at EBITDA level. So the change in whichever way will also be not a very big quantum jump. It will be in a narrow band, but it will improve.
Okay, all right. Hi, Mr. Banerjee. Good morning and good to see you, Ben. Couple of quick questions. So double-digit revenue growth for the year is on the cards, right?
Should happen.
All right. Exports are going to recover. What about on the domestic front? How is demand shaping up? Because last time we chatted, you were talking about it being a little bit tepid. And though things have been a little bit subdued, have you gained market share?
Yes, we have gained market share in replacement in Q1 in both motorcycle, scooter, as well as in passenger car tires. In passenger car tires, we have been gaining pretty good in the premium end of the passenger car tire as well. Truck bus radial has been a steady performer. Coming to the demand side, in OEM first, you have seen YOY, there's a growth in MHCV. Though QOQ, they have degrown, but that happens always. Passenger is growing at low single digit, and the growth rate of two-wheelers is also coming down, especially motorcycle. That's the OEM part. We are maintaining our share of business and growing massively in passenger because the approvals are now coming through in the higher rim sizes. So we will continue to grow well by increasing share of business in OEMs. Replacement, the demand of truck bus segment is about mid-single digits. Here we are going steady. The passenger is subdued in replacement because of lower growth in the urban segment. That demand softness continues and will continue for some more time. Two-wheeler backed by rural and scooter growth is pretty robust, and we have gained market share here. So overall, I think between OEM and replacement across these 3 segments, we expect to have double-digit growth in the coming 3 quarters as well.
All right, double-digit growth in domestic business. What about international? That's about 1/5 of your revenues.
Yeah.
Are we out of the woods there?
We can't say right now because after August 1, we'll have to see what is the tariff for India as well as the relative tariff of India vis-a-vis the other companies, other countries. That relates to our growth prospect in the US. As far as Europe is concerned, I think the uncertainty has lessened a little bit because our order book for Q2 is very good. But we don't have very good visibility of Q3 and Q4 at this point of time. Q2 definitely is going to be better than Q1.
All right. And what about, the incremental capacity addition that you're doing? Because I remember you going down this huge CapEx plan, wanting to invest 10% every year for growth or invest for 10% growth every year, but not at the cost of your ROCE. We have seen an improvement in your ROCE over what it was, say, 3 years ago. But because of this incremental CapEx, that would be compromised for a bit, right? So what are the lower levels here, and by when do you expect them to improve?
Our ROCE's post-tax is still in double digit, and it is going to improve. This CapEx is going to improve that because we do CapEx in very, very small quantities so that ramp up of capacity is fast. We have very clear view of the demand. This is going to aid the premium end of the passenger car tires market in domestic OEM as well as replacement. And we are seeing market share gains positively in this segment. Our capacity utilizations are 90% plus. So, and this is very, very bite-sized, 450 crores, which will not really impact a company of our size to any significant impact on ROCE. And the international business, whenever the bounce back happens, let's say even if it happens after 2-3 quarters, it's going to add to the margins in this particular segments of passenger car tires.
All that, Mr. Banerjee. Final question before we let you go. We've enjoyed a lot of your advertising lately, especially the ones with the wordplay, Slippery Road and Girija Chowk, etc. How much more are you going to spend on ads this year versus what you did last year?
Well, Q1 has been heavy because of our IPL presence also, the strategic timeout, and this advertising is working well. We expect to maintain a 2.1, 2.2 to 2.5 kind of ratio as percentage of sale. If you see, we would like to maintain and this ratio right through the year.
All right, Mr. Banerjee, we'll take a strategic timeout with you now. Wish you good luck for the remainder of this year and hope things improve. We have the next management as well.
Well, that's right. Let's focus on Polycab. You know, the numbers have actually been resilient, though government capex is yet to pick up and there is signs of slowdown. But their growth has continued, which is heartening from a shareholder's perspective. We're now joined by the CMD, Mr. Inder Jainsinghani, and also Mr. Tongya, who joins in on the show. Hi, gentlemen. Good morning. Good to see you all in. And congratulations, actually, on yet another solid showing. You know, though there's a slowdown in government capex, there's a high base as well. Yet your cables and wires business is delivering double-digit growth with stable margins. So good to hear. Let's get a couple of factors out of the way. What was the volume growth for the past quarter? And if you could help us out between the mix, cables as well as wires for the past quarter.
Good morning, and thank you so much for having us. You're right. This was perhaps the best quarter as far as the first quarter is concerned. On your specific question on the volume growth, cable and wire business, which contributes 85% to our top line, registered a mid-20s volume growth. Within that, cable grew at a level slightly more than that, late 20s, and wires grew in early 20s. So overall, it was a mid-20s volume growth.
And what is the mix? Mix between cables and wires?
Broadly the same, around 70% is cable, 30% is wire.
Okay. All right. So that's about this quarter. Was wondering whether, you will continue this sort of growth going forward as well, because your long-term guidance is mid-teens in cables and wires. So that's the point that I wanted some clarity on. And the standout performance for the last couple of quarters has been FMEG. This despite, uncertain summers, etc., the fans business taking a bit of a hit. Your solar pumps business has done extremely well. So an outlook on both cables and wires volume going forward and the FMEG business with operational performance there.
Absolutely. So you're right. There is a bit of a mixed bag, but we gave our guidance in Jan this year for the next 5 years, wherein we believe we'll continue to grow at 1.5x of industry growth in cable and wire sector. And as far as FMEG is concerned, perhaps a 2x of the industry growth rate is what we would probably anticipate and aim for. On solar, you're right. There is a fair amount of favorable macros there. The government spend is there. We do solar panels and other than the solar as well, the FMEG business has registered a fair amount of growth, right from lighting, fans, switches and switchgear. On that, we believe the profitability will continue to grow. It was around 2% this quarter, break even in the previous quarter. And between now and 2030, we should be able to get to almost 10% of EBITDA margin in FMEG business.
Okay, all right. Let's talk about margins. You have reported a margin improvement of close to around 200 basis points. How sustainable is this number, if you can help us out with that?
I'll probably take you back to 2030 guidance, wherein we have suggested that FMEG will improve its profitability from 2% thereabout to almost 10%. And in cable and wire, historically, we have been guiding for 11 to 13%. There were a few quarters wherein the numbers were better than that particular range. We believe that we should continue to aim for a similar guidance of 11 to 13%. There are some upsides possible. For example, exports business, if it improves meaningfully in years to come, it's quite possible that we are able to beat our own guidance.
Now, exports, there's been a good improvement actually on a year-on-year basis, but on a sequential basis, there's been a bit of a dip. I know your guidance is to get to that 10% odd mark, but for this year, how much will exports contribute? And are you seeing a fair bit of traction? Because, with competition heating on the domestic front, all eyes are on exports as well. Not in the near term, but say in the next few years, that could be a big driver as well. Tell us more.
Absolutely, you're right. Exports is going to be a good driver for us as well as for the industry. We already have a presence in 80 plus countries. We have many international approvals, for example, for the geographies like US, Australia, Middle East, and EU. You're right. We are aiming to get to 10% of top line contribution from exports business. And generally, we are of the view that every year we should be able to improve on it. We are hovering around 5%. Every year there should be some improvement.
All right. Every year there should be some improvement in exports. The domestic, obviously, by the announcement of large players entering this space, everyone's wondering how the situation will play out. But we leave that for a longer term discussion as and when, they enter the marketplace and products are out for everyone to see. But Mr. Jaisinghani, I wanted your thoughts, in particular on the BharatNet opportunity. Time and again, we see news pieces of you bidding for that, you getting some more opportunities. What is the total addressable market here, and what is your opportunity possible here over the next, say, 1 or 2 years?
This is basically a long-term project, which is a government one that every village has to be Wi-Fi connected. So, which is a project we are taking has to be complete within 3 years. And again, new tenders will come. So already we got Karnataka and 2 states. I think so 1 or 2 states will take more, and we'll see that how best we can do. Our full team is ready for that, and already work is started in Bihar and Karnataka both.
But how big can this business be? Gandharv, if you could throw in some numbers here, what is your current orders coming in from BharatNet, orders on hand, and what is the addressable opportunity here? How much can you get over the next 3 years?
Basically, around about 8 to 10,000 crore already we got the order, which is we have to complete within 3 years, and which we are going to start from October onward. But again, we can think that we can take 5,000-6,000 more, because it has to be complete within 3 years. It cannot be prolonged.
Okay, 8 to 10,000 crores is what you have already. You can expect to get around 6,000 crores more worth orders.
Yeah.
Has to be completed over the next 3 years. Is this at a lower margin than the other businesses? And what are the receivable days on this?
Reasonable margin, payments are very good. Once milestone you are completing, you will get the payment. So it is on milestone system. And again, we have to do the maintenance services for further year also.
And margins are in line, right? Receivable days in line, both are in line.
Yeah, both are in line.
Okay, got it. If you could also tell us, your market share, you'll have been outgrowing the market. In the past quarter as well, according to your numbers, according to your calculations, have you all gained market share?
So I'll probably take you back to March numbers, wherein we believe our market share of the organized cable and wire market is around 27%. Directionally, we believe we would have gained some additional market share in this quarter, but I think we'll have to wait and watch for the other companies to declare their results. As you know, we are the first as of now in the industry to declare our Q1 results. Okay. We'll wait for them, and then perhaps in the next quarter, we can talk about the market share gain.
What about advertising expenditure? It's not too large a number, but that's come down by more than 35%. If you could tell us, what should the rough ad spend be as a percentage of sales, and will it pick up from here on?
You're right. It's an important expense line item for us, particularly for the B2C business. We believe in the second half of the current fiscal, we should be able to meaningfully improve. Directionally, it should be in the range of 3 to 5% of our B2C revenue. B2C, as of now, is almost 1/3 of our company's revenue. So that is how we can, think about the B2C advertisement spend in years to come.
And you have a aspirational target of B2C versus B2B sort of business, right? I think it was half and half.
I don't know whether we actually gave that guidance externally. I don't know the source of your half and half information.
I just bowled a googly. Please tell us your guidance.
Yeah. Internally, what we believe is we'll have to continue to grow at the industry level. We'll probably aim for growing at a rate which is going to be significantly better than industry growth rate and gain more market share. As of now, government capex is positive, which is helping us in growing our B2C business. We are trying our level best to make some inroads on the B2C side of it, both on the retail buyer and.
But half and half, give us the mix. Give us the mix. You know,
coming to that. Both the businesses continue to grow. It's difficult to imagine that we would be able to get to 50-50. We are hovering around 70-30. Hopefully, we would be able to improve a bit on the B2C side, but B2B business is doing tremendously.
All right. And CNW and FMEG, do you have a target there in terms of optimal mix?
Yeah, that is already what I was mentioning. The cable and wire and FMEG, both put together, is aiming for industry-leading growth. Whatever current ratios we have is quite possible over the period we are able to tilt more towards B2C business, but B2B business is doing a tremendous job. So it's going to be a good fun to watch.
And, we have been enjoying our interactions with y'all, as you all moved into profitability on the FMEG side of things, and now profitable at some scale. Demerger is something that you all would look at?
I think this is a thought which friends like you have shared with us over the last few years. We have not...
we can share all the thoughts, Gandhar, but y'all are the executors. So,
we have not deliberated on it. At the right time, probably board will discuss, deliberate and see what are the pros and cons and accordingly take decision. As of now, there is no current proposal.
Indar, Gandhar, thank you so much for joining in. We've been bowling googlies at you time and again, and you've, either decided to leave it or, just defend it out here and say that, okay, we will probably go ahead and do things as and when the time comes. Thank you so much. Thank you for joining in.
And solid form today. And thanks a lot, gentlemen. Numbers speak louder. So thanks a lot. And looking forward to chatting up with you as the year progresses. For the time being, slip into a short break, come back, focus on markets and stock-specific action.
Even as the market's lower right now, 160 points on the Nifty at the lower end of today's trading range for the frontline indices, all of them. We have Indian hotels that opened mildly in the green, saw a bit of a dip, and from there it's moved higher as well. The management continues to believe that things are looking good for the hospitality sector from here on. Over 3,000 crores of cash on their books. With that, we'll wrap up on this edition of Chartbusters. Thank you so much for watching. The team of Trading Art comes up after this short break.